The 2008 financial crisis became the worst economic disaster since the Great Depression. In just a matter of months, banks that had stood for generations collapsed, businesses shut their doors, and millions of people watched their savings, jobs, and homes disappear. What started as a seemingly ordinary financial problem would eventually shake economies across the globe, pushing countries into recession and changing the financial system for years to come. But how could something that appeared so ordinary grow into one of the biggest financial disasters in modern history? Was it reckless bankers, greedy investors, or had the real danger been building quietly beneath the surface all along? By the time panic reached Wall Street in 2008, the foundations of the system had already been weakening for years. To understand how one of the greatest financial bubbles in history finally burst, we have to go back to a time when borrowing money was easier than ever, confidence seemed limitless, and almost nobody believed the good times could come to an end, because that's where this story truly begins. Part 2. The perfect conditions. The story takes us back to the early 2000s. America was searching for a way to get its economy moving again. The dot-com bubble had burst. The attacks of September 11th had shaken confidence across the country. Businesses became more cautious. Consumers spent less. Economic growth began to slow. To prevent a deeper recession, the Federal Reserve took action. It began cutting interest rates. Borrowing money became cheaper than it had been in years. Loans were easier to get. Monthly payments looked more affordable. Before long, cheap money began flowing through the economy. At first, it seemed to be exactly what the country needed. Confidence returned, businesses expanded, consumers started spending again. But easy money has a way of changing people's behavior. Before long, it found its way into one place above all others, the American housing market. For generations, owning a home had represented the American dream. It meant stability, success, a place to build a future. As interest rates fell, the dream suddenly felt closer than ever. Advertisements encouraged families to stop renting and start buying. Banks and mortgage lenders promised that home ownership was within everyone's reach. The message appeared everywhere. Why keep paying rent when you could own a home instead? Millions of Americans believed it. More buyers entered the market. Demand surged. Home prices climbed. And every new record convinced even more people to buy before prices rose again. For a while, it seemed like the perfect investment. But there was one problem. Someone had to keep approving all those mortgages. As home prices continued to rise, banks became increasingly eager to approve new mortgages. The more loans they issued, the more money they earned. Before long, getting approved became easier than almost anyone expected. A weak credit score? You might still qualify. A limited income? That wasn't always a deal breaker. Very little money for a down payment? There was probably a loan for that too. These were known as subprime mortgages, home loans offered to borrowers who carried a much higher risk of falling behind on their payments. Under normal circumstances, many of those applications would have been rejected. Now, they were being approved every day. Few people saw a reason to worry. As long as home prices kept climbing, lenders believed they could always recover their money. It seemed like everyone had found a way to win, but that confidence was about to change everything. Before long, buying a home was no longer just about having a place to live. For many, it became a way to make money. Homes were bought, renovated, and sold again just months later for a profit. Some buyers purchased second homes, others bought a third. A few owned properties they had never even planned to live in. The strategy seemed simple. Buy, wait, sell for more. As home prices continued to climb, more people rushed into the market, and every new buyer pushed prices even higher. The housing boom had become a nationwide frenzy. Owning real estate no longer felt like a long-term investment. It felt like the fastest way to build wealth. But while home buyers focused on houses, Wall Street saw something even more valuable: those mortgages. Wall Street saw opportunity where others saw mortgages. Banks no longer needed to keep the loans they approved. Instead, they sold them. Thousands of mortgages were bundled together and turned into financial products sold to investors around the world. These became known as mortgage-backed securities, or MBS. The system changed everything. Banks issued loans, sold them, recovered their money, then repeated the process all over again. The faster they approved mortgages, the more money they could make. For a while, it looked like the perfect business model. But there was one problem. Not every mortgage inside those bundles was a good one. Many of the mortgages inside those investment packages were far riskier than they appeared. Investors wanted safe investments. Wall Street wanted more products to sell. Credit rating agencies became the missing piece. Their job was simple: measure the risk. The safer an investment appeared, the higher its rating. And, surprisingly, many of those mortgage-backed securities received the highest ratings available. To investors around the world, they looked like reliable, low-risk investments. Money poured in. Demand grew even faster. Wall Street responded by creating even more mortgage-backed securities. The cycle fed itself. Very few people stopped to ask whether those ratings reflected the true risks or simply made the investments easier to sell. And Wall Street wasn't finished yet. Its next invention would make the system even more fragile. For most people, MBS already looked safe enough, but Wall Street wanted to create even more products. So the riskiest pieces of different mortgage investments were gathered together and packaged all over again. These new investments became known as collateralized debt obligations, or CDOs. On paper, the idea made perfect sense. By combining thousands of different loans into a single investment, the overall risk appeared to be spread out. In reality, many of those same risky mortgages were simply being recycled into new financial products. The complexity made them harder to understand, but it also made them much easier to sell. Investors kept buying. Banks kept lending. Wall Street kept earning. The system looked stronger than ever, but a small number of people had started asking a different question. What if the entire system was built on assumptions that weren't true? To most investors, everything still looked perfectly safe. Home prices were climbing. Banks were posting record profits. Wall Street had never been more confident. But a small group of investors saw something different. Instead of watching home prices, they looked at the mortgages behind them. The numbers told a different story. More homeowners were struggling to make their payments. The quality of new loans was getting worse. And if home prices ever stopped rising, those losses could spread through the entire financial system. There was just one problem. Knowing the truth wasn't enough. There was no easy way to profit if the housing market collapsed. So they asked Wall Street to build one. And Wall Street agreed. Wall Street saw an opportunity. If investors wanted protection against a housing collapse, someone could sell it to them. The product became known as a credit default swap, or CDS. The idea was surprisingly simple. Investors paid a small fee for protection. If those mortgage investments failed, the seller agreed to cover the losses. It sounded like ordinary insurance, but there was one crucial difference. You didn't have to own the investment to buy the protection. Anyone could place a bet on whether those mortgage-backed securities would fail. The more contracts were sold, the larger the risks became. Wall Street earned more fees, investors placed more bets, and the financial system became even more fragile. Almost nobody realized how much depended on one simple assumption, that home prices would never fall. Then something happened that almost nobody believed was possible. Home prices stopped rising. At first, it didn't seem like a major problem. Sales slowed. A few homeowners missed their mortgage payments. Foreclosures began to increase. Then the trend spread. The weakest loans started to fail. The mortgage-backed securities built on those loans quickly began losing value. Confidence disappeared. Banks stopped trusting one another. The flow of money through the financial system began to freeze. What had started as a slowdown in the housing market was becoming a full-scale financial crisis. And the biggest collapse was still ahead. Lehman Brothers. On September 15th, 2008, the unthinkable happened. Lehman Brothers, one of the oldest and most respected investment banks on Wall Street, filed for bankruptcy. The collapse sent shockwaves through the global financial system. If a bank of that size could fail, who would be next? Almost overnight, confidence vanished. Banks stopped lending to one another, afraid that the next institution might collapse before the money could be repaid. Credit markets froze. Businesses struggled to borrow. Companies delayed hiring. Some couldn't even secure the short-term funding they needed for everyday expenses. The crisis was no longer confined to Wall Street. It had begun spreading through the entire economy. Within weeks, millions of ordinary people would feel its consequences. As banks pulled back on lending, businesses struggled to survive. Hiring slowed. Investments were canceled. Layoffs spread across the country. Millions of people suddenly found themselves without a steady income. Many could no longer keep up with their mortgage payments. Foreclosures surged. The crisis soon spread far beyond the United States. Banks across Europe reported heavy losses. Stock markets plunged. Global trade weakened. Governments around the world faced a decision they could no longer avoid. Either step in or risk watching the entire financial system collapse. Emergency measures were announced. Banks received billions in financial support. Central banks slashed interest rates to keep money flowing. In the United States, Congress approved a massive rescue package. Slowly, the panic began to ease. The banking system survived, but for millions, the crisis was not over. Jobs had disappeared. Homes had been lost. Savings had been wiped out. The emergency had been contained, but rebuilding the economy would take years. The worst of the crisis eventually passed. Markets recovered, and the global economy found its footing. But the financial crisis left behind a changed world. It reshaped how financial institutions managed risk and reminded us that rising prices can create a dangerous illusion of safety. Nearly 2 decades later, the effects of 2008 are still felt. It changed how millions of people think about debt, housing, and the nature of greed. If you enjoyed this story, please like this video and subscribe to the channel. Thank you for watching.